Alright guys, welcome back to a new session of XMC. So let's start the session without wasting any time. So as you know, we have already covered the core, which is market structure, daily bias and weekly bias. Now it's time to take it one step further, because knowing the bias is powerful, but if you don't know how to execute based on that bias, you are just guessing. So today's session is all about refining your execution, how to take only high quality trades, the ones that respect your bias, your system and your risk. So let's get into it. No overtrading, no fear, just calculated and high conviction setups. So in simple terms, we have covered how to define bias daily, weekly, and how to build a directional mindset. Now comes a major piece of puzzle, which is where do we actually look to buy or sell. That's where the concept of POI, point of interest, comes in. Every single high quality trade starts from the right area. It's the perfect sitting not inside the right POI. Today, we will break this down into step by step and more importantly, understand the logic behind every POI we will ever use. So, if you look at this chart now, if you look at this sell candle from here, the market has moved down aggressively, and then the momentum with which the market dropped, the market went up with the same momentum. So what happened here is that the market had to go up. Logically, this is a momentum candle. Normal retail traders look for a sell here, and momentum traders also look for a sell here. Many people place their orders below this low. As soon as this low breaks, their stop order get triggered. But we don't trade like this, placing orders here or getting trapped in such false trades. Okay, now if you look at this candle, it dropped with strong momentum. And then look at the next candles. The market reversed with the same momentum. So something happened here that forced the market to reverse. Okay? Okay, now what actually happened is that sellers and buyers agree on a price, either to push the market up or down. So here if you see, there was a strong sell momentum, and then from this point we got strong buy momentum. Even this candle closed completely, and the wick shows a rejection. On a low time frame, this is also a bullish candle. Now sellers gave their full effort to take the market further down, but buyers enter on the same candle. Okay, and the deal between the sellers and buyers were made. They found a fair price to buy, and immediately after that, you can see the volume of buy. Now, if you look at the order flow chart of this same candle, you will see aggressive orders throughout the entire candle. And in this area, in the week, the orders are drying up. Sellers are exiting, and after that, buyers are injecting and entering the market. Now, if you want to see how strong a seller or a buyer is in any area, then you should look at the wicks forming in that area, how the market is closing the candles and how the wicks are forming. If we look at this area of this wick right here, followed by this strong bullish rejection candle, this wick and this one, it clearly indicates that buyers have entered from this zone. Buyers volume has been injected, which caused the market to push up sharply. Even the market couldn't break the low of the last candle. And within This candle's range, the market started to move up. This means that in this candle, the main volume from the buys was injected. As I mentioned earlier, if you want to understand the volume and how it behaves and whether an area is strong or not, just look at how the candle wicks are formed. Okay, so here's what happened. We have an area and this is the candle that's actually a momentum candle. The point where the overall momentum shifted. So this is the area where we will see the trade to buy. But we are not going to trade like other SMC traders. Well, this is the candle where the main volume was injected, the main buy volume. Now look at this wick. The market closes the previous candle here and next candle opened from the same point. The market first travels down, then gets rejected and pushes upward. That rejection drives price up to this point. The market reaches this level and then it drops again. And finally, we get a candle closing here. Now we have two areas here. One is this candle's wick and the other is the wick from the same candle. Meaning both wicks belong to the same candle. This is the first wick where the market pushed up, then it came down, creating this second wick. So now we have this second wick. How did it happen? So the candle opened, the market went down first and then it rejected and came up. So in this candle, your main volume has been injected. And because of that, the next candles broke the high directly. Okay, so now we have an area inside this candle from where we will look for buy or sell trades. In this candle, the body is of no use to us. We are not interested in it, unlike others who mark order blocks based on the body, saying this is your order block. We don't follow such useless things, okay? So now we have the downside wick of this candle and we have the upside wick. Your pending order should be placed somewhere within this range. As soon as the market taps these wicks, we will get a sharp reaction. The market will move up or down instantly without asking or giving any warning. Okay, so we will study further how orders are injected into the market. First of all, it's important to reduce the volume of the previous orders that are already in the market. Only then can new orders can be injected in the next direction. For example, by sellers, let's say this was the last seller's candle with a lot of volume. In this case, it was necessary for the sellers to exit. Only after that, new volume can be injected. So if we look at the wick of this sell candle, all the sellers were exiting here. Otherwise, this candle could have closed like this or like this, just like the previous momentum candle. But that didn't happen. Now, sellers have started exiting from this point, which is why you see such a big rejection candle, around 100 to 120 pips. That means sellers have started coming out from here. And when sellers exit, only then can buys be injected into the market. Now look at the next candle. When price dropped below, the sell positions that were sitting here started closing. That's when buy volume got injected. Once buy volume was injected, we got the first move. Suppose the market had dropped and you had sell order stacked across this whole range. Once those sell orders get closed, once their main targets are hit, only then buy volume get injected from that point. Now, whatever volume was injected from this area into the entire range, suppose it pushed the market up to this point, but that move alone is not enough. Let's say the market is supposed to travel even higher up to here, but from the volume injected earlier, we only got this limited move. So what happens now? The market will revisit this area again, and when it does, it will pick up the remaining pending orders sitting there. After picking them up, you will get a sharp move, and the market will reach your main target. This is how the order formation works. The first move is created by the initial rejection of liquidity, just enough to give us a signal or early movement. Then the market pulls back and revisits the same area where volume was first injected. From there, the remaining volume, the part that was not injected in the first move, gets picked up again, and then the market continues in the intended direction. If you look, same thing happened here as well. The market revisited this area, and after revisiting, we got to see the main move from here. Now, if we see further here, so if you look at this candle when the orders were closing and the market was moving up, the market came up to this point, then dropped, and after that you got the main volume from here. That means the actual momentum is inside this candle. Now, this tells us that even before the candle opened, the order was already injected. So where did it happen? In this range. In this week, the market first moved down, the order was injected from this week, and then the market pushed up. So, the most likely area where the market's order was placed is within this week, inside this range. Let's look at some more example. If you check this next one, it's a similar case. The market was dropping. Look at this candle, and even the one before it, the market kept falling. Now look at the next candle. The sellers are getting weak. They are failing to control the market. Then look at the next candle. There's a big wick here and another big wick here that clearly shows sellers are losing their strength. Now focus on this candle. This is where the main volume is, and where was that volume injected from? It was injected from this candle. Again the same thing, the market came up to this point and then dropped. Here your candle closes. After the close, volume is injected and you get this main momentum candle. The market is imbalanced and you can clearly see the imbalance here as well. This is an imbalance area. Now this means that the order injected in these candles should be either in this week or in this week. In this case, it was in this week. As soon as the market moved up, it dropped again. All the sellers had to exit, and they did. And from here, the main volume was injected from the wick. After that injection, the buyers pushed the market with strong momentum. So next time when the market revisits this area, it will tap into the same order and the market will move sharply to the upside again. Okay, here we have another example and the same thing is repeated. The market was dropping non-stop. Now look at this candle and also the one before it. As these wicks are forming, it shows that the sellers in the market are getting weak. The market even tried to go up And these weeks means that prices came up to this level but couldn't sustain. It dropped again. So sellers were here pushing the market down. They were active here too. But now look at these weeks. The sellers have started exiting. The remaining sellers mostly exited in this candle, and the same pattern again. No strong wicks or break downwards. Then comes another candle. The last one closes. A new one opens. Market drops, and the remaining sellers exit. They needed a fair price, and they got it in that area. Now look at this candle. A large momentum candle that broke multiple highs. Now, before this candle, the order had already been placed. And where are those orders placed? Yes, on the wicks. Look at the wicks. Price came up to this point, dropped from there, then the next candle opened and pulled back slightly. After that, we saw strong bullish momentum, a large impulse. This tells us that the pending orders were in that week. Those are the orders the market will revisit, pick up again, and then move in the next direction. The market came up to this level, picked up the orders that were resting in that range, and once picked it, it didn't stay there. The market never stay where orders are picked. Whenever the market taps into a pending order, a passive order, it moves immediately. And by passive order, I mean limit orders, your limit orders. When limit orders are picked, the market should never stay in that area. If it does, there's a high chance that your setup is weak or low quality, and also a high risk of stop loss being hit. Your entry should just tap and fly. But if the market doesn't stay there, it just comes, hits the area, and without wasting time closes above it, then that means more order were injected in this candle. And after that, the market gradually started moving up. And this was your first move, and then market picked more order from that area, and then you got to see the main move. And yep, we get to see this kind of data in the market on daily basis. Our job is to find out where the main area is, where the market is getting hit, and then follow the direction from there. If I click on the chart here and we look at this setup, what happened? First, let's focus on this area. Look at this zone closely. Of course, we will add more confluences to this later, which will make your setups even more high quality. But for now, understand this. On this candle, the order was injected, and in this next candle, the main injection happened in this week. You can see that the market came back and revisited this area. After picking up the order, it didn't stay. The market moved straight in the next direction. So remember, whenever the market takes a passive order, it doesn't stay there. In these areas, you will notice wicks, and in the direction where the order are injected, wicks appear. Like here, there's a pullback, and as these wicks start forming, it shows that sell orders are being injected. The moment a wick forms and the candle look closes with that wick, it means the sell orders has been injected there. Now the market won't revisit that area again. It won't even come back to your break even. You won't see any drawdown. The market will go directly to the upside. And that's what I call accuracy. Now, if you look at this example, the same thing is repeated. These wicks here shows that buy orders are starting to get injected. And the market did the same thing. It revisited the area, and after that, you can see you didn't see any major drawdown. Even here, the market didn't give any drawdown. and then it made a strong move toward the next liquidity. From this area, we almost you got a move of almost 900 pips with a very minor drawdown. Well, we have multiple examples here. Look at these wicks. They show that sell orders have started injected. Earlier, the market was just going buy. Then momentum shifted, wicks started forming, and sell orders were injected. The market revisited that area again and boom, dropped. If you look at this example also, there was a structure here from where momentum started. That's where your passive order was placed. The market revisited that area and dropped. Bam. Okay. So this is the logic behind our point of interest. But this is not the final or actual way of marking it. In the upcoming session, we will learn how to find more points of interest, like, and how to align them with multiple confluences to make them high quality. When done right, prices won't stay at the level for long, and you will be able to catch trades with little to no drawdown. I repeat again, train your eyes, train your eyes, train your eyes. See you in the next session.